Hi everyone, it's Alex here at Sestrin Capital Research. Welcome to our weekly webinar. It's Thursday, the 11th of July, 20 past 4 Eastern for the benefit of the tape. Sorry for starting a few minutes late. Today, a fairly short agenda in terms of number of items, but probably some reasonable discussion, I would hope. So we had a CPI print today, which was pretty good, came in lower than consensus, and there is various sort of noises off that suggest the Fed might start to cut rates sooner rather than later. There was a quote from the San Francisco Fed to the effect that shelter inflation was coming down a bit slower than normal because of lack of supply, but nonetheless coming down, and that all things were being considered. So sort of noises off about a Fed rate cut. The market reaction was slightly odd insofar as the S&P and the Nasdaq were down. Dow about flat, Russell up quite strongly. Bonds are up. And so I wanted to run through some measures on each of those to sort of get a sense of where we are in the equity indices, to look at bonds as well. And then we had a number of short-term chart requests, which we'll look at: Meta, Datadog, Apple, Nvidia, and then we'll have time for plenty of Q&A. We are about to start earnings season. Banks start tomorrow. They're early reporters, as you know, so we'll get really into the flood of earnings over the next week or two. But for now, we can keep it light, indices, charts, and so forth. Before we do any of that, we'll do our disclaimer. And as always, and in particular, if you're new here, welcome. We run these webinars on a live and open mic basis. The thing that makes the webinars great is if we have plenty of participation. So if you have questions, comments, points, anything, do not sit back. I absolutely guarantee if you have a question or a point to make, it will be a great question, a great point. There are no such things as dumb questions in investing and trading. So please do make the point or ask the question. Many ways to do it. Open your mic and shout into the system. I'll open system mics in a moment. Or use the question or the comment functions here in the webinar platform. Or you can use the chat room in the Seeking Alpha Growth Investor Pro Rocket Chat room, all of which means you can get questions over, and if it's on audio, everyone will hear them, and if you type the question, I'll read it out for other people. Okay, so let's do our disclaimer on your screen right now. This webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Sestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrin Capital Research. Sestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so first of all, let's switch mics on. Just that right now. Okay, so microphones are on, so you have anything to say, don't sit back, say it. Let's deal, first of all, with bonds. So I'll switch to that screen right now. Okay, so on your screen here now is a longer-term chart of the US government bond, the 10-year yield. And this is, you could think of this as a proxy for the price of money, if you like. So when the yield is high, money is expensive, and when the yield is low, money is cheap. And very roughly, over longer periods of time, the cheaper money is, the more expensive stocks will be relative to where they were previously. Why I say relatively is because money is more expensive now than it was in the COVID lows, but stocks, of course, are more expensive. So it's not a relationship that holds perfectly over time. But in general, if you see a downward move in the price of money, you will generally see an upward move in the price of stocks. And you will most certainly see an upward move in the price of bonds if the bond yields are falling. Remember, the yield is the earning stream that you're making on a bond that you bought. So the more you pay for a bond, the lower your yield, and the less you pay for a bond, the higher your yield. So as yields go up, bond prices come down. As yields go down, bond prices go up. Now, if we go all the way back to the COVID crisis lows back here in March 2020, money was basically free. The bond yield was 0.3%. And there's some logic to that, right? Which is, what is it you want to own when the world's ending? Well, US treasuries aren't a bad idea. So people piled into those. It was a safe haven. And then the yield climbed as, first of all, equities became more attractive than bonds. And then secondly, as inflation rose, and then the rate hike cycle kicked in, the yield climbed, meaning bond prices fell. Bonds do not like inflation because they are, if you like, fixed income instruments, where if you hold them to maturity, the best thing that can happen is you get your money back. If inflation is very high, then the money you get back at the end of the whole period will be worth less than the money you got at the start of the whole period. And so inflation, bad for bonds. It's bad for two reasons. One, because the principal is deflated, if you like, at maturity. And two, because if money market funds are paying 5% and bond yields are 5%, where do you put your money? You put it in money markets because there's less risk to principal. So inflation, bad for bonds in two ways. One, it deflates principal, and two, because it makes the holding risky relative to cash. So here we see a 5-wave upcycle in the price of money, the yield. 1, 2, 3, 4, 5-wave high. And this didn't finish until October 23. The equity bear market low was in October 22, and the 10-year yield was at 4.3% then. A year later, when equities were very much rallying, the yield was higher at just around 5%. Once the market started to scent that inflation was probably falling and that rate cuts would probably follow, the yield started to fall. So this is the October 23 high, 5%. Here is an A-wave low at the end of December 23, 3.8%. And then as the prospect of fading inflation retreated, and you can see that all over the Fed language, general economic commentary language, worry about shelter inflation, sticky inflation, all of that. Through 2024, the yield rose and hit a local high at the end of April at about 4.7, 4.8%. And then that started to fall as CPI reports started to improve and as Fed language started to soften, and it looked like we would see some cuts. And it hit a local low at the middle of June at 4.2%. Then it did something which is to be expected. You would expect it to fall then. Then it did something strange. So middle of June, it then rocketed up to here. So from 4.2 to 4.5 in a fairly short amount of time. And the narrative for that was, we might get a Republican administration and they might be more inclined to cut taxes and borrow to spend more than we thought, and that's likely to be inflationary, and that must be bad for bonds. Was the narrative. So whether that's true or not, I have no idea. You could also see it as just a simple technical retrace back up. In any event, it's now started to fall. The yield stalled out until today at around 4.3%, but today it dropped a lot, down to an intraday low of 4.2%, and it closed at around just over 4.2%, but it was a big move today. So what does that say? That says that the bond market thinks that inflation is falling, and it says that the bond market thinks that rate cuts are probably coming. If we were to look at the most common way to play bonds with ETFs, TLT. So this is a daily chart for the TLT ETF. So this is in essence the inverse of that yield curve. Now TLT is a 20-year bond ETF, 20 plus year I should say, not a 10-year, but it moves more or less in sync with the 10-year yield for our purposes at any rate. And so this is the low back in October 23. That corresponds with the yield high. We get a run up until December 23. So yield was falling, bonds climbing. And then we get this A, B, C correction down to a local low on the 24th of April. And then it started to climb what looked like a wave 3 up. And again, we just in the middle end of June, we just get this slightly odd drop here. But that's looks like it's moved up and corrected. And I suspect that bonds will start to climb now. Now, in general, you can say that if bonds are moving up, probably so too are equities. It's something of a myth, except in extreme conditions, to say that people sell equities to buy bonds. Generally speaking, if the price of money is falling, you want to own bonds and you want to own equities. Again, other than extreme conditions like COVID crisis lows, when equities look very risky and bonds look much safer, relatively speaking. So that bonds moved up today, I think, is a bullish sign for risk assets in general, because I think the bond market smells a rate cut coming. The other ETF you can use for this, we don't cover this in this service, but we do elsewhere, is TMF. So TMF is the 3 times levered version of TLT. So it tracks the same patterns, but it just gives you more volatility to the upside and the downside. And again, this put in a solid up move today. It's a red candle because it closed lower than it opened, but all of it opened and closed way above yesterday. So again, looks like TMF is moving up quite nicely. And for disclosure, I am long TMF. So that's bonds. Now, normally, when the yield drops as hard as it did today, equity indices move up quite a lot. And that didn't happen today. What happened was the S&P dropped, the NASDAQ dropped a lot, and the Dow was basically flat, and the Russell was up a lot. So, why is that? Well, I think if we to look at especially the short-term chart of the NASDAQ, I'm going to use the futures here just because there's more trading data, it's institutional volume. We can zoom in a bit here. Then if we look at the most recent moves up, this level here is a 2021 all-time high, and we had a local low on the 19th of April down here. Since when, NASDAQ's put in a 1, 2, 3, 4, 5 waves up, peaking on the 20th of June, sold off a bit down to the 24th of June, and then started a new cycle up. 1 up, 2 down, 3 up. And intraday high today, it hit the 200% extension of this wave 1, placed this wave 2 low. And that's a pretty extended wave 3, so it's not surprising on that chart that we've seen a sell-off today. And the intraday low held over that wave 1 high there, and it found support at or around a 0.5 retracement. Now, in fact, a more common place to hold support will be the 61.8 retracement down here, which would coincide almost exactly with that wave 1 high. So I would not be surprised to see a bit more weakness in the NASDAQ over the next day or so. Now, you've seen me write as well about a potential Q3 correction. This might be the start of it. It's a bit early, to be honest. If you were to look at seasonality for, actually we use QQQ for this. So this is the last 25 years of QQQ, that's the NASDAQ 100 ETF. And what this shows is over those 25 years on average, what's the percentage of times that a month closed positive? So July is the second best month for the NASDAQ usually. In 73% of examples of the last 25 years, QQQ closed July positive. August is a sort of middling month, and September is a really weak month, and only 44% of cases in the last 25 years did the NASDAQ with the QQQ close positive. So you can see that typically you get some Q3 weakness. First month of Q3, second month, third month, and then some Q4 strength. October good usually, November good usually, and December fine. So I do think we'll probably get a Q3 correction of some kind, and perhaps it started today. It's a bit early for that, I would say. So if I had to guess, obviously be completely wrong now, if I had to guess, I would say there's maybe a bit more local downside in the NASDAQ and then a run up, And after this run up for a wave 5 high, and that could be, just over today's intraday high, it could be a bit further, but it's not. I don't think it'll be a massive move up from today's intraday high. I suspect after that we get a more sustained sell-off. But if you look at the size of that move today, it could very well have started today. So for disclosure, as of just after the close today, I am hedged the Nasdaq 4 parts long, 1 part short. So that's 4 parts TQQQ to 1 part SQQQ, and I have some European stuff on the side that's at the moment unhedged, but will be hedged by tomorrow. So assume I have a similar ratio in those European ETFs as well. Why? Well, because the Nasdaq's in a sustained bull market up. I really don't want to be net short the Nasdaq at this time, because that could really harm me. If I'm 4 to 1 short, if the market keeps going down, well, the short leg is making money, and at some point I can sell that hopefully for gains. I did sell a small position in SQQQ today for gains, and then roll that profit back into the long. That the long is falling, I would treat as a short-term thing. I would expect it to be going up again in Q4. And so I don't mind the long side falling a bit if I'm making money on the short side. I'm hesitant to be more than 4 to 1 long to short, but if things turn really ugly, I might go 2 to 1 long to short, or 1 to 1 long to short. We'll see. So that's my take on the Nasdaq. And the Nasdaq is the most extreme downside mover today. Let's look at the S&P. This is the ES futures. Really not as dramatic a move today. So the S&P was down less than a point today. I don't think you can say that's any kind of disaster. A 1 point move is no big deal for a sort of a correction. And the S&P, if we just zoom in a bit here, look at today's candle. It's the futures, but the ETF will be the same thing. It closed above yesterday's open. So the new all-time high was made on the intraday, sold off, didn't close at the lows, came up a bit from the lows and closed a bit above that. So I'd say it's an inconclusive candle today. We may see some more sideways, maybe a bit down. The Nasdaq to me looks like it might have a bit more down, specifically to try and hit that 61.8 retrace there. If we look at the Dow basically did nothing much today, and you could argue, I think, that it's at a local high. We might see some weakness, maybe. Why I think that is, here's a low made on the 30th of May. Here's a 1 up, a 2 down, a perfect 78.6 retrace, a 3 up, a sort of a messy 4 down, I think. Technically breaks that wave 1 high, but I can live with that. And what looks like it may be a local 5 up that's just exceeded the 0.5 extension of that 1 to 3 combined, place the wave 4 low, which is a long-winded way of saying that move up from the 30th of May low might be complete, and we might see some weakness in the Dow, or if not weakness, then more sideways. Personally, I sold out my Dow position, I think it was earlier this week, pocketed some gains, missed out on this move up yesterday, but I can live with that. And at the moment, I just have no Dow position, nothing long, nothing short. I'm just waiting to see what happens. Finally, the Russell. Story of the day today was the Russell. Why? Well, because there is a perception, I think, that when inflation comes down and rates come down, small caps will benefit. I don't know if that's true. I haven't really back tested it. What I know about the Russell is it's a really good index to trade. It's not a great index in which to invest, in my opinion. So here is the Russell on the IWM ETF for the last 2 years. Here's April 2022, and here's July 2024. It's done nothing as an investment. It's just bounced between 160 and 200 and 160 and 200 and 160 and 200. So as a trading instrument, I think the Russell can be terrific. As an investment, why would you want to hold this? And so it's made up of lower quality issuers than is the S&P on the Nasdaq. And so I do not personally see this as any kind of core holding, but it might be that the move up in the Russell is sustained. If we zoom in and look at the RTY futures again, just because there's more trading data, probably this is where we are. Here's a low on the 19th of April. Here's a wave 1 up. Here's a 61.8 wave 2 retrace, and probably we're in this wave 3 up here. Now that could reach all the way up here, 23.58 on the futures, in other words, a long way up from here, or as is the Russell's want sometimes, it could top out a bit sooner. That's a big candle today, and it's also on big volume, as you can see. Again, this is futures, not equities, but the same will be true in the equities. So I have, at the moment, let me see, I'm 2-to-1 long to short the Russell. I have an underwater short position in TZA. I banked some gains on TNA today and then re-entered a TNA position. So I'm 2-to-1 long to short the Russell. If the Russell falls, then I'll probably keep the long position if it goes underwater, try to sell the short at a gain. And if it keeps running up, if I do nothing, then I'll end up with a net profit because of the 2-to-1 long to short ratio. So the question for the Russell, I think the big question tomorrow is, does that fade? It's not a coincidence that this closed right at this wave 1 high that was struck back on the 15th of May. If it climbs over that and turns that into support, then you have a wave 3 confirmed in progress. That's bullish. If it fails there and sells off again, then it can run down a fair bit. I would be surprised if it dropped below this wave 2 low, but you never know. So in short, for equities, some consolidation I would describe it as in the Nasdaq and less so in the S&P. Semiconductors sold off hard today, and that led the drop. Big cap tech in general sold off a bit. Small cap tech or smaller cap tech was up for the most part. Don't view that as a reliable sign. Personally, I've seen plenty of times money rotate out of big cap into small cap and then everything sell off. Why that is, I don't know. But I've sort of learned to not think that just because MongoDB or something is up when Microsoft is down, that it's all going to be roses tomorrow. That's not my experience. My experience is the opposite. When you see these weird days when smalls are up and bigs are down, that gives me more worry, not less. Okay, before we move on to single stocks, anyone have any questions, comments, anything at all that they want to discuss? I have someone with a hand up. Ron, hey, how you doing?
Hello, Alex. I'm
Hey.
good. Thanks for excellent presentation so far. A lot to go back and ponder here. Would you mind going back to the QQQ month by month bar chart over the past 25 years?
Sure, yeah. Here we go.
Okay. So in this chart, you pointed out that July is up 73% of the time in the month of July
Yeah,
compared to, other months.
yeah.
And you said based on that, you were and have had moves to be consistent with the general trend in July for QQQ. So the next thing you showed was the QQQ chart. After this, would you mind
Yeah,
pulling that
sure.
up?
Here we go. That's QQQ. Yep.
So what I was confused about here is you said that in spite of the general trend in July being up, you were expecting a sell-off, and you
Yeah.
lost me there because I was thinking,
Yeah.
well,
Okay.
wait a minute, if 73% of the
Yeah.
time it's down,
Okay.
why are you expecting?
So this is a question of time frame. So what I purely based on well, two things actually. Firstly based on history, and secondly based on someone else's analysis. I don't normally do that, but I don't use any flow of funds analysis. In other words, I don't look at inflows into ETFs and inflows into money markets. It's just not a tool I have, and I wouldn't have the time to do it anyway. But Goldman have a really good analyst that does that. A guy called Scott Rubner, who publishes fantastic stuff for Goldman clients, and some of that bubbles up to the public internet. So you can find some commentary on Scott Rubner's Rubner on his work on CE Alpha. There's a great note out from Rubner, I think it was this week or last week, and it basically said that the inflow of funds into major ETFs, SPY, QQQ, all of that, had slowed, and in his opinion, he couldn't see what the bullish catalyst would be to suck in more funds. Now he's been very bullish all year, unlike most of the sell side analyst community has been puzzled and bearish and completely wrong footed by how strong the market's been since the October 22 lows. I don't know why, because for nearly 2 years now, in fact more than 2 years, the market's basically been trending up. But nonetheless, most sell side analysts continue to be bearish. Rubner's been pretty bullish, and somebody else's technical chart isn't very interesting to me because I think the charts we produce are pretty good. They can always be wrong, but they're pretty good. But flow of funds interests me. It's a different lens on how to read the direction of securities. And I sort of buy it that says, well, any money that's had any reason to get sucked in, it probably has already been sucked in. And what that means is if you are a large account player, you probably want to take some profits for two reasons. One, prices are at these terrific levels, and two, it'll scare late bulls and they'll flee, and that means you can use them for exit liquidity now, and then buy at lower levels later on. And in election years, what you tend to see is a sell-off into the election, and then regardless of the outcome of the election, a run up afterwards. And if in option parlance, it's a bit like rising implied. It's a bit like having rising implied volatility or expected volatility. So people worry about the election outcomes. They worry that their own candidate's not going to win, or the other guy's going to do something terrible to the world, or whatever it is. But worry climbs into elections, and then after the election is done, it's like bursting a blister, which is everything settles back down. The volatility generally falls, and if volatility is down, risk asset prices typically rise. And so my expectation, and it's only my expectation, and it's yet to be proven by fact, is that I think that into August and September, I would expect some weakness in equities. I don't mean a fundamental dump. I don't mean a bear market. I mean something of a correction. And so on time frames here, what I've been looking for is if that correction is going to happen, when will it start? And so, as you've seen from trade disclosures, I've just been reducing risk, reducing exposure, raising some cash in some accounts, repaying, margin loans in a trading account, and just dialing back risk so that I can do one or two things.
I've seen that.
Yeah,
Yep.
so either if the market moons, I can just wind longs back on, that's fine. And if it goes south, then I've got plenty of capacity to add shorts. So my question has been, if that correction happens, when will it be? And my big question today was, well, is this it? Is this the start of a sell-off? And it might be. But why I think it's a bit early is, one, that big July candle that you just mentioned, the seasonality candle. July is the second most likely to be a positive month over the last 25 years in the Nasdaq. And also, if we just look at this shorter term Nasdaq chart, I think that this move up from the 25th of June is incomplete, I think. And I think that today looks like a wave 4 retrace of this wave 3 up from the 1st of July, I think. And if that's right, and one of the reasons I think that is where it stopped today. It stopped at the 0.5 retrace. It could definitely drop to that 61.8 retrace for sure tomorrow. But if I'm right, we'll see another push higher. And I was sort of messing about with this today, which is if you assume, roughly the same angle of attack, the same, rise in price per day, if you like, then you could still push into a new high and still be in July, which would give time to sell off into August and September and still be consistent with this pattern. So all of which is to say, I think that we will get a bounce in the Nasdaq and a move up before a Q3 correction starts. I mean, of course, that could be flat wrong. There's a lot of volume today, as you can see. So it could be that this is the start of a sell-off, or it could be we get a bounce and it doesn't sell off. I don't know. But the thing I've been sort of a bit twitchy about personally and just watching for is, are we going to get through Q3 weakness? I think we are. Last year we did. And if so, when does it start? The context here is I made a right mess personally of Q3 last year. Did okay generally, and it worked out very well for the year. But I made a mess of the Russell specifically. So I had too much of a long Russell position in, I'm going to say, August. And then as it started to sell off, I didn't hedge it nearly aggressively enough. And I took a real beating on it. I didn't realize the losses. I just sucked it up. And what it meant is that at the lows in October, if I recall, or early November, I had to really put a lot of allocation into long Russell. And then fortunately, the whole thing rallied back and it worked out great actually, but it caused me a lot of ulcers and worry. And I don't like to invest and trade like that. I like to be much calmer. And so the context here and why my trigger is set probably a bit too happily for a sell-off is because I don't want that to happen to me again. Because it was, as I say, it worked out fine, but it was an unpleasant experience, and it was my own fault for messing up. I was too much long exposure, too much leverage, and too slow to hedge into a correction. I'm trying to avoid doing that again. Now, of course, we always try to correct for the mistakes we made last time around and make a different mistake this time, so that will probably happen here. I'll probably be underexposed and underlevered and all those things. But that's my sensitivity, which is I really, as I say, Q3 last year was not fun. It worked out fine, but it was not enjoyable, and I don't wish to have the experience again.
Okay, thank you, Alex. That was an unbelievable answer to my question.
Well, some of it might even
Thank
be
you.
true. Who knows?
Well,
We'll see.
I think it's going to, let's see, it'll be fun to
That's
watch,
good.
but I think you're right on the money.
Yeah, that's
And thank you also for bringing into consideration that it is an election year. And I think I remember reading somewhere that of all the election years in the past 40 or years or so, this has been the biggest election year bull market ever. Is
it
that
has.
true? Do you happen?
Yeah, I
It
think it
has
is
been.
true. Yeah.
Yeah.
Do you know what
Okay.
puzzles me? And obviously we don't do politics, but what puzzles me is no one's screaming that from the rooftops, right? So it's just a very strange environment where you have this incredible economic setup where the markets are on fire, inflation's coming down, employment looks pretty
Yep.
good, and everyone's completely miserable about American economic prospects. And an outsider, I simply have no clue why everyone is so depressed about it. I don't understand it because life looks pretty good, compared to anywhere else in the world. So it is a great surprise to me to see the facts on paper versus the sentiment. Um, so that's a great environment in which to invest because sentiment negative and market bullish, brilliant. Have at it. But it's very odd to watch.
Yes. Yes. Well, if I know you don't ever talk politics, but I would just mention briefly there's a great fear by the Democrat Party that Biden will not be able to beat Trump, and they're doing everything possible to win, and even getting Biden out of the White House, which all the people that I've read and listened to say Biden will not be the Democrat candidate. So he just had a horrible debate performance. His dementia has been evident to the world now. They can't cover up for him anymore. So there's a lot of turmoil in the country that the president of the United States has pretty advanced severe dementia, and
And, and there's
not the
there's
one. He's not the one running the country.
And there's your implied
So
volatility. There's your implied volatility right there. So it's these sorts of things that cause sell-offs into elections. And what I expect to find is, frankly, regardless of who the candidates end up being on either side, and regardless of who ends up being president, because the answer is there, the volatility bubble tends to get popped, and then prices rise. Pretty much, not every single election year, obviously, but pretty much across the board. So worries mount. Whatever the worry is, I'm worried that this guy is going to be president and he's not capable. I'm worried the other guy is going to be president and he's going to destroy the republic. Everybody's worried about something, right? Worries mount, um, and then when the worry pops, implied volatility collapses because realized volatility is lower than IV and equities rise is usually what happens. But as the worries, everyone's worried, right? But someone always thinks their world is going to end, right? And the positions are irreconcilable. They can't both be right. but nonetheless the worry level goes up. There's your implied
Yep.
volatility. There's your Q3 sell-off, and that's the opportunity to try and buy that at the lows.
All right. Thank you, Alex. Outstanding.
All right, talk to you soon. Paloma, you're up.
Hold on. Sorry. Hi, Alex. How are you?
Good, thanks. How are you doing?
Very good. Well, very shocked with the market today, as you can imagine. That's why I said, good news is bad news.
Yeah.
I wasn't
Not for small
expecting.
caps, apparently.
Yeah, but I don't look at small caps anymore. I just got bored of it. It's as you say, it's good to trade, but not to invest. It's
Yeah.
I'm not looking at them anymore. Um, I wanted to ask you about the XLK. It was
Yeah.
down 2.5. QQQ was down 2%.
Yeah.
Uh, if 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 it would have to be an index of your choice, thinking about this potential further weakness coming, blah blah blah. Which one would you think is better or more rational investment, the XLK or the QQQ?
Well, I can only tell you what I do. So I have my biggest single holding by a country mile is T triple Q, but by a mile. And I've started accumulating that in August 22, which was a terrible, 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 terrible time to start because it then dumped royally for the next 3 months or something. But I sort of made a decision that we were sort of at or around the lows, and I figured I'm going to accumulate that thing and hold on to it, and you can prize it out of my cold dead hand until such time as the next bull cycle rolls over. So um, I like T triple Q. XLK's outperformed it. XLK's outperformed triple Q. TECL has outperformed T triple Q, and SOXL has outperformed T triple Q. But the Nasdaq has more diversification in it than those names. It's less volatile to the upside and the downside. So me personally, I think the Nasdaq is just a great instrument to own. And one of the things I do in my own accounts is that I constantly track long-term sort of cumulative performance versus the S&P and the QQQ, and you can go back. If you own the Nasdaq, you get more volatility than the S&P, and you have to learn to live with that. But it is just a gift that keeps on giving, as long as you're patient. And so, me personally, I'm more at ease with owning a Nasdaq than I am XLK. But that would have been the wrong decision from the March 2020 lows. You would have made more money if you'd held XLK, and even more money if you'd held SMH or SOXX. But me personally, I don't mind a bit of diversification. I like the huge assets under management in QQQ and by extension T triple Q. So for me, it's the Nasdaq. But that's a lower risk answer than owning XLK. XLK has performed better since the COVID lows than triple Q.
Okay. And the other quick question, SMH got hammered today.
Yeah.
Did I read that there was money I think I did on the chat. Did I read that some of the SMH money was going into software?
Well, what you can say definitely happened today. Just get hang on, up here. So this is not organised by sector, but if we just flick down this list, let's look at the key semiconductor names. So ARM down 7 points, Broadcom down only 2 points of Broadcom, but then again, Broadcom's half software. So where's NVIDIA? Marvell 3.5 points, NVIDIA 6. And then if you look at enterprise software, by and large, it was up. Autodesk up a point. Adobe was down actually. Okay, CRM flat. Okay, so it all sold off a bit towards the end of the day. So during the day, Datadog 0.5 point. During the day, a lot of these names are up quite a lot. What was odd today was you had, trash like Unity, and for disclosure, I'm long Unity, unfortunately, up 7.5 points. Fastly, which I'm also long, sadly, was up 4 points. So slightly strange, which is that some money went into, very low quality names whilst it was coming out of Nvidia, which is not all that sensible in my opinion, but that is what happened. I suspect that's a short-term artifact. When I've seen in the past money come out of the mega caps and the small caps go up, it's never ended well, right? So it's usually been followed by a general sell-off. And I can convince myself that won't happen this time, but I've seen that on multiple times, so it makes me nervous. So I suspect there's a bit more selling to be had yet before we find a footing. I mean, if this is SMH here, let's just chart this out. So,
wow, I didn't see ARM minus 7%. My God,
yeah.
I hadn't seen it.
I mean, if we look at, so let's just look at SMH 1 second. Okay, so because don't forget, everything went up at the start of the day. CPI print, pre-market, everything went up. So this sort of topped out somewhere shy of a 200% extension wave 3. Which really, if you think about, just how strong semiconductors are, that's not that big of a move up, really. I mean, so it doesn't seem to me. I keep saying this about Nvidia, it's not actually up that much relative to itself, given all the good things that are happening in semiconductor. So let's look at how much it's dropped. Yeah, so I mean, there's a tiny sell-off really in SMH today. I mean, so it's not even of this local wave 3 here from the October 23 low to the July high. I mean, it's not even a 23.6 retrace. So I mean, it could easily sell down to 228 and it would still be an immensely bullish chart. So, you can see every reason why you might have a bit of weakness ahead. But, context for me is why I'm not heavily short or even one-to-one hedged is this is such a strong bull market, and the fact that CPI is down, jobs look good, the Fed looks like it's getting ready to cut. I don't think you want to be short equities into that environment, because there's one thing which is a sell the news, which we got today. It's another to sort of sell Goldilocks, which is what it looks like being. Inflation coming down, GDP fine, and jobs good. Rate cut cycle coming. I mean, don't forget, the US is late, right? The Bank of Canada cut, the Bank of Switzerland cut, European Central Bank cut. The rate cutting cycle around the world has started. The Fed's late, so it will happen. I'm sure it will. So I'm really hesitant to be structurally short equities into that environment. I think that's a way to get hurt. But I'm just worried about whether this sell-off today continues and whether we get a seasonal sell-off. But fundamentally, I think we're still in this bull market.
Okay, thank you very much.
And I would expect SMH to, but I'd be surprised if at the end of the year SMH wasn't higher than now. It doesn't mean we can't take some pain, along the way, but I'd expect it to be higher by the end of the year.
Yeah, but you don't think it's the moment to go into the famous, the one we saw last week, the IVG, the software ETF?
Well, let's have a look. My view here is coloured by my own Q3 experience last year, as I say, and so that's my own prejudice, and it might not be right. I was kicking myself all quarter for messing it up, but to say it worked out absolutely fine, but it was just more stressful than it needed to be. So here's IGV. I looked at this last week. So right now, okay, so it's a triple top, right? So here's the 21 top. It made a top here in February, and again here it's rejected it. So right now you'd say, what's a safe entry point? You'd want it to see it move up and over, 90 or something, turn 90 into support, and if it does that, then probably off to the races. But it's rejected that level 3 times. So I suppose you would say you'd want to see it turn that resistance into support first and then think about going in. And then you can place a stop, a few dollars below 90 or something, to control your risk on the downside. So yeah, if it was me, I'd probably wait to see it over 90. On XLE, by the way, I'm doing the same thing. I want to buy into XLE, but what I'm waiting for is I want to see it climb over 93 and hold it as support, because it made this top in June 22, November 22, January 23, September 23. It pushed through briefly early this year, failed. So for XLE, over 93 and holding it, I'd like to buy in. And IGV, yeah, looks like over 90 and holding it, I would say. That would be my approach anyway.
Okay, super. Thank you for all your answers.
Great questions as always. Thank you. Right, I have a question on the chat board from Preston, who says, okay, he says, this is a good question. I don't think I'm going to give you a very good answer on this. Okay, it says, hi Alex, bit of a semantics question, but is the flow of funds analysis you mentioned by Goldman the same as volume, or is flow of funds measuring something different? Yeah, okay, right. I'm not going to give you a very good answer here, but in short, no, it's different. Flow of funds means money if you think about this simply, which is where can money live? It can live in cash, it can live in equities, it can live in bonds, it can live in options, it can live in alternatives. Flow of funds typically refers to money coming out of one of those pots and into another. So if the flow of funds out of money market into equities is positive, then you would typically expect equities to go up. And if the flow of funds is neutral or negative, as in flowing out from equities into money markets, as you saw as the rate hike cycle played out, then you would expect that to be negative for equities. So at the very highest level, that's what they mean. Now, people get very, 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 very technical indeed about what flow of funds means, and it's not my world. And so what I've given you is a high-level answer, but you can think of it as money flowing between different asset classes, basically. So if there is a flow of funds from equities to bonds, as we saw in the COVID crisis, bonds are going to go up and equities are going to go down. Think of it like that.
Got it. Thank you.
Welcome. Good question. Klaus, you're up.
Yeah, I had this question in the chat before, and I don't know if I got the answer today, which was like, if there's a sell-off, do you expect the likes of Twilio and Unity, Fastly, etc., all the ones that are deep in the red, to either benefit from that or go down even further? I mean, obviously today they had a good day, but that could be a fake, and I don't know if I should be scared or holding on.
Yeah, they should be hammered if there's a sell-off, because I mean, why wouldn't they be, right? We talked about this in chat recently, but if you look at these three, there's three names I own and I really wish I didn't. And it's nobody's fault but my own. One of which is Fastly. You know, that's not great. It's to state the obvious. Sort of looking okay until last quarter's earnings, then the bottom dropped out. It's held this all-time low, which is some comfort. And you know, it's not a bad business, but it's tiny. Nobody cares about it, and somebody just needs to come along and buy it and put the stock out of its misery. I have too much capital in this thing. It's colossally underwater. Terrible risk management might be, but the actual amount of capital, number of units in it is so low at this point that if it went to zero, it would be irritating, but not ruinous. So I don't mind just waiting. Unity, same story. Don't have much capital in that. And Twilio, same story, and don't have much capital in that. So in theory, if we get a market sell-off, these things should be absolutely smacked. Why they might not be is because as the price of money comes down, the other thing that happens is M&A activity ticks up because it's easier to finance acquisitions. And so you will see increasing amounts of leveraged buyouts taking place over the next year or two as leveraged loans become cheaper. You'll see increased corporate M&A activity as corporate bonds and high yield bonds become cheaper. So each of these companies, Twilio, Fastly, Unity, they all need to get bought, in my opinion. They're not sustainable as standalone companies. The stock price proves that. Various management team changes in those companies prove it. They need to get bought. And tech is a place where you don't survive long as an independent. If you can't make it, you generally get soaked up by a bigger friend. And I do expect that to happen here. So for that reason, personally, I'm not selling them. Having already failed to manage my risk in them, I figure it's so low at the bottom now that because if they went to zero, I could live with it. I might as well just own them and see if I can recover some value. The same happened to me in Matterport, MTTR. Same story, too much capital in it, averaged down wrongly, should have sold out, and took small gains or small losses, didn't, wrote it down. And I figured, again, that will get acquired. It has been, it's under acquisition by CoStar, CSGP, part stock, part cash deal. And if that deal goes through, and if, as I suspect, real estate recovers somewhat, then I'll probably end up back whole. If I make money, I'll jump for joy, but I probably won't lose much, and I might get my costs back. And my risk management strategy there has been patience. In having, again, failed to manage risk, subsequently my risk management was patience, and that's paid off with Matterport, and I suspect it can pay off with these others as well. All of which, by the way, is absolutely dreadful practice, and everyone should treat that as a case study in what not to do.
I mean, I'm right there with you. I mean, I bought a bunch of Unity just yesterday, so for today that worked out, but it could.
Well, that's great. You're up
Yeah.
7%. Brilliant. Well done.
But not enough to get me green, so otherwise I'd be out. Yeah.
Yeah, but your question,
Okay.
but then your question is, what do you do, right? Because 7% up on anything in a day is 7% up on anything a day. So there's no harm in going, well, I'll sell that bit, thank you. And I've paid down some gains against it. So now, my total realized and unrealized loss on that thing is a bit less because I actually took some profits. Whoopee. Nothing wrong with that.
True. Yeah. Good point. Thanks.
And personally, I tend to do that. So if I have an underwater position that I average down, and I sell some of, I sort of make a note and go, right, well, this, I made X from this, and therefore I only have to recoup Y to at least be whole. And so, I think it's a perfectly good strategy to chip away at that, particularly with these very volatile stocks. Okay. Any more questions, folks, before we wrap up? Let me just check the chat room. I'll tell you what we haven't done is the short-term charts people ask for. So if it's okay, I'll post those later on. I'll post them in chat. So we had questions on Meta, Datadog, and Apple, and NVIDIA. So if it's okay, I'll post those in an hour or two on chat, as we don't have time to go through them now.
Hi, Alex. I have a question about the indices. So we just look at the seasonality of QQQ and the others, and Q3 is in general weak for the equity markets. But on the other hand, rate cuts are on the horizon, which typically are bullish for the equity markets. So how do we reconcile that? I mean, like, we are looking at 25 years of data, but there are periods of data which are not related to rate cuts. That's one.
That's right.
And then linked to this is, do you see possibility of divergence in how Russell behaves as compared to Dow and QQQ in case there is a correction in Q3?
No, that's a good question. I mean, yeah, if you look at average seasonality, election year seasonality, the rest of it, if you ignore the fact that we have the fastest rate hiking cycle in history, which is about probably to start reversing, and the fact that the Fed is probably late already, yeah, you would say that this may not be an average Q3, I guess is your point. So yes, I agree, which is why I'm hesitant to take on material short positions until such time as it looks like a real correction is in flow. I see everywhere, talk of, there's going to be rotation out of big caps into small caps, but when does it ever happen? For anybody who watches the Chivaco Capital videos, if you don't, you should. I'll post a link to them in chat later. They did this brilliant analysis. They look at small caps versus big caps over the last 25 years or something, and big caps just keep outperforming consistently. So I really personally think that, yeah, the Russell's great to trade. It's volatile, it's liquid, all of that. But why would you want to own the Russell versus the other indices? It's composed of fundamentally worse companies, that carry more risk as individual issuers. They're more sensitive to the economic environment, the rate change environment, all of that. why structurally would you want to own more Russell than the S&P? I don't know. I wouldn't. And so when I look at my trading history, the Russell's been really very productive for me, but it's never enjoyable, ever, whether it's long or short. I always treat it as it's going to give me an ulcer. And it's worked out really well, actually, but it never feels good. Whereas owning the Nasdaq or the S&P, I figure like it's going to go up. And if it sells off a bit, I'll try and make some money short and then back long. And overall, until such time as something fundamentally changes in the US, they're probably going to keep going up. So I don't have to worry too much about the long side. I just have to make sure that I hedge properly and take profits on the short side and don't overstay my welcome on the shorts. Whereas the Russell, I mean, it's sort of like why would you want to own junk bonds rather than treasury bonds? You wouldn't, if you ask me. So that's my view.
All right, thank you.
Ron, you're right. Ron has posted Apple 3 times, and you're right. I owe an Apple chart. I'm going to post it in chat later on because we're out of time. But I will do Apple, Meta, Datadog, and NVIDIA later on. So, right, we're out of time, folks. Let's wrap up. Great session. Thanks, everyone, for showing up and for some terrific questions. Much appreciated. These things are always much, much, much better when we get discussion going. Video will be live in an hour or two once it's upscaled to HD, as always. Thanks, everyone. See you in chat later on.